Now we're going to turn to the global energy markets. And one of the things that we wanted to kick off with is Iraq, because we saw some big discounts coming out of the OSP, really targeting the US and Europe, with Asia staying fairly flat. But one of the two that we want to call out right now is Basrah Light. So here, when we look over the last 5 years, just to give you an idea of kind of where things sit. And the reason why I want to look at this seasonally is because a lot of times they'll do discounts, they'll do increases depending on where we are seasonally. So this is a sizable drop when we consider where this was previously, and this is coming to the US. So again, this is going to shift some of this flow that was going into Asia, and that's going to come now pretty much firmly into Europe and the US, which again is also going to compete more aggressively with URALS in the underlying backdrop. So one of the things that we wanted to look at is China's daily crude oil processing fell to the lowest in 15 months. Amid that, again, that virus resurgence. Processing sank to 13.8 million barrels a day in August. That's the lowest since May 2020 and 1.2% down from July. So China's daily crude oil processing fell to that 15-month low. And when you look at just what does that mean, it just means that they're not going to require the same type of crude over this month, especially now when you look at the new surge of COVID cases and just the push to keep people a bit at home, if you will, going into through September. So then when we look at heavy, you can see that there was another big discount. It's not quite 2016 levels, but you can just see where we are on that big drop down and just how competitive it's going to get, especially when you look at what's coming out of the Middle East. Now, when you consider what does that mean for the rest of the region, well, Trafigura cut offers for Fortes, for essentially all of the North Sea levels, where for early October delivery, when you look at dated Brent, it went, it's now at 30 cents plus, was at 50 cents. When you look at all of these setbacks, Fortes for September was at plus 80 cents. So you're seeing some of these drops in general. Brent for September 27th is at negative 65 cents, was at negative 30 cents on Tuesday. So you're seeing a lot of this accelerated drop down, and it's really on the back of what is happening when you look at Iraq and URALS as the competition is there. And then looking at Libya, so Cedar is seeing more protests. So far, there's 3 ports that are closed down, Cedar being a major one, and then 2 smaller. It's not like the previous one where there was about 800,000 barrels that were at risk. Here, there's something closer to about 300 to 400,000. But there are ongoing negotiations to try to adjust that to keep that from happening. And then when we look at some of the additional and backdrops, and as we said earlier, it's going to provide some support for URALS, where we saw that discount go from $1.05 to $2.65. So we're just going to see some of this setback. So Glencore sells 100,000 tons of URALS, delivery at $2.55 less dated Brent, which is the lowest price for URALS since August 16th. And then NE bids 650 Azeri Light at $1.80 more than dated Brent. So we have some of that coming through. And then ESPO, if you remember last month, had a huge drop down, was at a 5-month low. It's now up month over month, but still down when you look at where we normally were. And it's really because we've got this fairly sizable move where when you look at what has happened so far, so Russian oil prices were hit on exports jump and Iraq supply, because Iraq again announced a sharp price reduction for European buyers as well, which is going to keep some of that targeted. And that's also going to put pressure again on U.S. exports. So when you look at what has been sent so far, so U.S. crude exports our total volumes for September is about 940,000 barrels a day, which is the highest since June. We're going to see some of that pare back, but again, you're still going to see some of that hold through, because there's that kind of fixed amount that is exported from the U.S. of about that 1.8, 1.9. The issue is going to be Asia, because when you look at what is happening there, you have more of these products coming through. That's going to put more pressure on additional U.S. products going into Europe. But then when you look at URALS going out, when you look at CPC, that's where you're going to see, and then you look at West Africa, where Nigeria is going to have to compete, Angola. Some of this additional Middle East, especially from Iraq, will come into Europe and the U.S., but then that opens up the ability for Asia to purchase, and especially China, and essentially take full allotments that they want from Saudi, UAE, Kuwait. And they've already nominated to take their normal deliveries, but not extra. So again, you're just seeing something fairly flattish, and that could change as we see, or depending on how big this COVID outbreak gets. So when we look at U.S. crude exports, so gasoline was down 100,000 barrels, distillate was down 323,000 barrels, which again is distillate's going to continue to be under pressure. Gasoline, as we've been saying, that sideways move. Propane, propylene, that LPG was down 112,000, but still 385,000 over the 5-year. Some of this is going to get impacted when you look at what did Nicholas do, and given the fact that most of these items were down for about 3 days, depending on passage, that is going to create some lumpiness when we look at the backdrop. We did get an increase of 282,000 barrels a day of exports, going from 2.34 to 2.62. Still, again, at the low end of our range. We were expecting a little bit more, closer to 2.7, 2.8. But again, just something very similar. We could get, again, that makeup number, but realistically, we want to look at that average over time, which again is going to be that 2.6, 2.8 million barrels a day of exports. Here's when we're talking about the spreads, especially as we talk about going into Asia. WTI Dubai holding in firm right here at this, let's call it 350. Where Dubai still holds that discount. It's going to be difficult to see this compete where Dubai is going to continue to be the favored blend when you look at movements into Asia. And the same can be said for Brent. Even though we do have a record, or I should say a 4-year high, or more than 4-year high of production coming out of the North Sea, that's going to, based on what we're seeing now, that's going to, they're already starting to increase those discounts. And a lot of that is going to end up in in Europe and really not compete to go into Asia right now. They could continue to increase discounts to try to incentivize some of those movements, but we think that there'll just be an increase of consumption internally within Europe and some of that floating storage. So then when we look at gasoline, as again, it's just above the 5-year average. We think that's going to continue, and it's because it's still, some of this is classified as naphtha. That's something that's going to have to be considered going forward. And we think that there's going to be some of that residual going through. We'll still see an increase going forward. It'll just be above the 5-year average, but within the top of that cloud. So then when we look at distillate had a huge drop off. There will be a recovery, but as we keep talking about distillate in general, there's a lot of competition out there for disti, with more cargoes coming into the Atlantic Basin, coming into China, into Europe, and coming as far as, again, India, Singapore, coming all the way over. And then we're going to have China sending more product into Pad 5 and continue to see those movements over the next few weeks. Then when we look at crude oil exports, again, just top of the cloud, staying within that tighter range as we've discussed. Here we're at about the 4-week rolling average. We're at 2.7, so right at the sweet spot of that what we're expecting going forward. Again, that's going to be fairly stable as LPG, can't stop, won't stop. Still seasonally adjusted all-time high, and that's going to continue to be on the upper end of that level. We could get that 1 week drop because of Nicholas, so it's just some of that's going to be a little lumpy going into next week, depending on how quickly they can normalize activities and get pilots out there moving boats. Then when we look at India total petroleum product consumption, here you can see that we've had a decent drop. It's still above 2021, but still above 2020, but again below 2020 in normal levels when we go back through 2016 to 2019, and we just continue to see the pressure on the distillate side continuing and which is pushing more product into the market, as we've also continued to see coming out of China. Then when we look at Genscape ARA, another bigger increase, as we've been saying, coming back to that 7-year average. We just think it's going to continue to be, right within that average level. The additional cargoes coming out of the North Sea is going to come into the European markets and just keep us, I would say, just below that 7-year average, but be seasonally normal when you average it out over the coming few weeks. Now, when we look at flows, so here when we look at Russia, that's what we were talking about. You had a decent step up in September flows coming from Russia of about 300,000 barrels. You had that increase in Norway, Nigeria, again, struggling to sell cargoes. So we have that steady move down. Libya is sitting there. They've cut their OSPs as well, trying to compete, but they have the protests that is an issue in general. Angola had some of that slippage from August into September into October, but we will see additional flows because things are moving at a normal pace at this point from Angola when you look over the last 5 months. But those 5 months are below normal, but again, still normal for the new normal, if you will. But when you look at Nigeria still has 2/3 of their cargoes to sell for October, and some of those are even reoffers. So again, there's a lot of problems in West Africa, which is resulting in additional discounts as well as that floating storage, as we see that North Sea and Norway continuing to push higher. Now, when we go back over the last few days, and we just wanted to again provide some of that update for pricing. So Gunvor, again, that 100,000 tons of URALS, it started at $1.05. It's now down to $2.55. Then when you look at CPC blend, that is sitting there with the amount that's kind of struggling to move cargoes. Crude loadings for October are set at 5.4 tons from the terminal near Russia's Black Sea, equivalent to about that 1.38 million barrels, which is the highest since June, compared with the revised 1.12 for August. The biggest field, the Tengiz field, is undergoing planned maintenance August 1st to September 15th. So again, we'll be on the other side of that. Nigeria sent a signal that the recovery in global oil demand has a long way to go. As much as 2/3 of Nigeria's crude for October export has yet to find buyers. And again, that's continuing to be very, very slow for this time of month. Nigeria's crude for October loading remains slow to European buyers so far this week, and based on Iraq's OSP cut, it's about to get much harder. MRPL seeks to buy crude via tender while we look at what's going on so far. And then when we look again at some of the movements, China's Unipec bought Brazil's 2P crude for November arrival at a premium of $2 to $2.20 to $2.30 to the ICE benchmark. And then when you look at where some of the other flows are, spot differentials for crude favored by the different entities. So then they also bought 2 cargoes of Russian ESPO for end September to November arrivals at $2 to $2.60 premium to ICE, which is up month over month. Remember, last month they got down to about $1 premium. Now they're back up to about a $2 premium, $2.60 premium, depending on delivery. Again, there's some recovery there, but it's just a matter of where is that recovery coming through as Europe and Asia continues to take what they need, which is a little bit less, which is less than normal, and that residual is getting sent into Europe and the Americas, which is coming in at a point of putting more pressure on just where the OSPs are, where that price is, and what those differentials are going to look like, because the spreads are starting to blow out again. And then the question is, how much is that going to benefit some of the refining diffs if you can buy some of this crude for cheap and try to push it through? Now, when we look at Fujairah, so Fujairah reported 16.284 million barrels, which total stocks were down 2.178 million. That's down 11.8% week on week, and it's the first time below 17 million since September 2018. And this is where we saw this big shift, as we were saying last week, of a lot of this is coming into Europe. A lot of this is coming into the Atlantic Basin. We have a lot of movements from the Middle East into Europe. And the question is going to be timing on when it gets refilled. When does that shift come from Asia or from Middle Eastern refiners into Fujairah? Where does it go on the other side? And then you also have that middle distillate pitch for that purchase when you're looking at Bangladesh, Pakistan in terms of gas to oil movements on electrical generation, because LNG is very expensive right now. It's going to get more expensive, and you're going to see more fuel oil being adopted, especially that heavy resid. So then when you look at total stocks in general, so light distillates fell 858,000 barrels to 4.897 million. The Asian gasoline complex got a little bit better this week, but then it was really because of, again, what happened with EIA and with some of those movements coming through because the Texas Gulf Coast refining complex, including Exxon's 2 Texan refiners, Baytown plant, and Beaumont, prepared for the tropical storm. One of them did lose, the Baytown did lose feedstock, so that went down temporarily. That should come back over the time period, and then all Texas oil ports reopen after Tropical Storm Nicholas. So then when we look at some of the other shifts in general, India's domestic demand for gas oil typically declines over July, August due to seasonal heavy rains that tilt the power generation mix in favor of hydropower. So right now, when you look at what some of the shifts are, road traffic and transports have also gotten impacted with the way some of the things are adjusting on the demand side from monsoons. So you'll see an impact to gas oil and gasoline. But one of the things when you look at some of the shut-ins in general, so you'll see light distillates continuing to starting to build back up as we have those exports from China, some of that India demand declining. And then when you look to middle distillates, which had a decline of 68,000 barrels, to 3.916, some of that will start to get refilled as you get slower demand in Asia, and then again some of that refill from the exports that have gone from Fujairah into the European or the Atlantic Basin. And then heavy resid fell 1.252 million. Or 14.4% to 7.4 million. And this is a reversal of last week with spot trading starting to get a bit more tepid. As we've been talking about, there's always those peaks and valleys when you're looking at bunker fuel sales. So bunker fuel sales spiked, came back down a bit. They're still, again, elevated as we come into that peak period for shipping. But you'll also see more heavy resids getting purchased and or recracked for the use in the electrical generation side, especially when you look at some of the third world countries. So when we look at crude oil in the water, just below that 5-year average, things are going to stay fairly stable at this point, as we've been talking about, just going kind of sideways. We will see a bit more coming into storage over the coming few days. Global oil in transit, this is where the transit has dropped down. Global, when you look at what is moving into storage, so transit has dropped, but global storage has picked up. This will, just based on some of the movements we've seen, we should see transit increase a bit. Again, still below the 5-year average, but move into a bit more of a normal position, especially when you look at what is coming from the Middle East and into Europe and the U.S. So then when you look at oil floating storage, you had a small drop here, but again, you're still at this elevated level. We're still just there's a lot of support to stay in this region. We could get that one drop down because of Nicholas, because of the Typhoon Chanthu in Asia. But once those again park themselves again, additional ships show up, you'll have that movement once again. And then when we look at Brent time spreads, we're still off the highs, but elevated in general. We don't see that adjusting just given where the market is at this point. We did get a drawdown from the U.S. There's still some of these movements in general on the time spread side, but when you look at differentials and you look at spreads overall, and this is not looking at time spreads, but looking at spreads in terms of what is the discount to dated Brent, you're starting to see that accelerate to try to move things through. Then when we look at December had a nice recovery back to 6 for both. That's something where we think it'll start to normalize a bit. But as we were saying before, we just think it's gonna live and go sideways at this point, because there is a lot of views as we go into December 22 that there's going to be this big surge of demand, which is keeping some of this well situated and well bid. On the refining side, things stayed fairly heavy when you look at Singapore. This is just because of availability of cheaper cargoes, the pricing in general of crude products within the region. And then as we go forward and moving through the system, you continue to see some of these headwinds, especially with the damage that has been done now to Chinese demand for September, the increase in exports, and then the monsoon seasons within India impacting some of that near-term demand, which again is keeping things fairly well off of the 5-year average and closer to the bottom when you look at the hydrocracking side. Now, URALS, refining margins are staying fairly firm, especially when you look at the Northwest Europe. That's going to incentivize that additional pull through of crude, and now that we've seen some of the discounts from a URALS perspective, from an Iraq Basrah perspective, we'll see some of this, again, some of these margins will get a bit better. Refiners will stay fairly active. There is space within the U.S. complex to continue to run, and we do have more capacity, some of those exports coming to the U.S. as they do take in more imports from Asia and the Middle East. Then when we look at the Mediterranean, there's we still have that pretty widespread. Not much has changed since last week, except Libya. Libya is going to be this unknown in terms of how much is going to be shut down, how much is going to be reopened. So we're going to continue to see some of this backdrop in general as we go forward over time. Then when we look at China's supertanker, here you can see we're back above the 5-year average. It's just going to be how much of it shows up, how much of it gets resold if they can. We expect, again, most of this will show up and then turn into that floating storage that we talk about. Here is when we look at run rates at the Shandong side, 71.4%. As we were saying, it's just going to go sideways from here. The state-owned refiners have been very sluggish, and we don't see that changing, especially when you look at the amount of exports that have increased, which is just going to keep them from coming back and picking up as a huge ton of crude. And again, that's why we think this Asian floating storage is going to remain elevated. We have more cargoes ready to show up, and it's just going to be a matter of timing of when they come off the water, and that's going to keep us fairly elevated in Asia. Now, when we look at the North Sea, again, as we've been talking about, discounts are accelerating, cargoes are showing up. So we're now back above the 5-year average, and we still think it's going to be more of a sideways move just from this newer, higher level, just because they're struggling to clear those crudes, even though it is at a discounted rate. So then when we look at West Africa is still elevated based on what Nigeria is saying, what we're seeing. It's going to stay above the 5-year average as we have that competition. And now the Middle East has shifted up. So when we look at this in general for 2021, we're now above where we were in 2020. And when you look at the discounts in Dubai, you look at the discounts in Iraq, there's a lot of crude that is waiting to get moved. And I should say that are stacking up behind it. So that's why you're getting some of this competition. They don't want this crude sitting in floating storage. They want it in the market. And you're starting to see that get incentivized. But with the additional production, with some of that slowdown into Asia, we do expect to see some of this accelerate and really go above where we were in 2018. But still, I mean, not going to 2016 levels, but just setting that new, if seasonally adjusted high, taking out 2016 obviously, and seeing some of that elevated levels. Europe, small grind. That's something that, again, more of a sideways move. We think the comps get easier, so we'll come right back to that 5-year average as we continue to see stock builds in Shandong ports. Again, there's offshore, there's onshore, there's a lot of product in China that continues to be there. And then when you look at fuel oil, here's that huge explosion to the upside with fuel oil storage now at all-time highs. And a lot of this is going to be used for recracking. A lot of this is going to be used for blending. And this is a way that the Shandong or teapots are going to try to manage some of their throughput and flow in general. So we didn't do Singapore and Europe just because we did it last week, and last week because the EIA was on Thursday, that was all real time. So it would just be a repeat of last week. So for the sake of time, we're going to cut that out and we'll add it in again next week. So if you have any questions, please let me know. You can find me on comments, Twitter, wherever, whatever is convenient for you. I'm happy to take questions. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.